What are you doing to increase your market value? Because these prices are here to stay. Yes, they're not going away. And prices are just going to get higher and higher and higher. It's not going to get any lower. The question becomes, will your market value outpace inflation? If your market value doesn't outpace inflation, hell is around the corner for you and your family.
As you sit at home, hearing reports that a recession might not hit in 2024, it's easy to feel a sense of relief, thinking, at least it's not as bad as predicted. But what if the reality is far more troubling? What if what's coming could shake your financial stability even more, making you wish that a simple recession was the worst of your worries? Patrick Bet-David has sounded the alarm. The rising prices we're seeing aren't going away. And if your market value doesn't keep pace with inflation, the financial storm ahead could be far more destructive than a typical economic downturn. So, if you're curious about what's coming next and how it could affect you, stick around. This is one video you don't want to skip. Recessions, while powerful and destructive, are usually temporary. They come, they cause disruption, and then they leave, allowing for recovery. But what if this time the storm doesn't pass? Instead of a short-lived downturn, we could be facing a prolonged period of stagnation, where inflation remains stubbornly high, debt levels continue to soar, and consumer confidence plunges. This scenario is not just possible, it's likely. In this video, we'll explore why 2024 could be one of the most challenging economic years we've faced in decades and what you can do to prepare. And before we dive in, make sure to like, share, and subscribe so you don't miss any of the critical insights we're about to explore. The economic outlook for 2024. Let's start by rewinding to the late 2000s, a time when the world was on the brink of financial collapse. The Great Recession hit hard and fast, leading to widespread panic, massive unemployment, and a market crash that left deep scars. But here's the thing, that recession, as devastating as it was, had a clear start and end. The economy eventually rebounded. Now imagine an economic scenario where the challenges are subtler but longer lasting, where growth slows to a crawl, inflation refuses to budge, and the financial pain lingers indefinitely. That's the reality we might be facing in 2024. A soft landing or economic stagnation? The term soft landing is being thrown around a lot these days by economists and policymakers. It sounds comforting, doesn't it? The idea that the economy can slow down just enough to avoid a recession without tipping over into full-blown economic disaster. But here's the catch. A soft landing might still feel like a hard crash to millions of Americans. According to recent forecasts, GDP growth in 2024 is expected to hover between 0.7% and 1.2%, a significant drop from the more robust growth of previous years. What does this mean for the average person? It means an economy that's growing just enough to avoid a technical recession, but not enough to create jobs or boost wages significantly. Think of it as treading water. You're not sinking, but you're certainly not swimming either. And for many, this stagnant economic growth could feel like being stuck in a recession, with the added frustration of not knowing when or if things will get better. But here's where it gets even more concerning. While growth might be slow, inflation is likely to remain stubbornly high. So, even though the economy isn't contracting, the cost of living continues to rise, eroding the purchasing power of consumers and making it harder for people to make ends meet. And just when you think that's the worst of it, there's more to the story. In the next section, we'll explore how this persistent inflation could hit your wallet in unexpected ways and why the Federal Reserve's efforts to tame it might not be enough. The double-edged sword of persistent inflation. Let's take a moment to think back to the last time you went grocery shopping. Did you notice how prices seem to inch up every time you visit? This isn't just in your head, it's a symptom of what's known as persistent inflation. Normally, inflation is expected to cool off as the economy slows, but that's not what we're seeing now. In 2024, experts predict that inflation will continue to hover above the Federal Reserve's 2% target, driven by a mix of geopolitical tensions, supply chain disruptions, and lingering effects from previous fiscal policies. Now, you might be wondering, how does this affect me? Well, persistent inflation means that while your income might stay the same, the cost of everything around you, food, gas, housing, keeps going up. And with the Fed keeping interest rates high to combat this inflation, borrowing money becomes more expensive. So, if you were thinking of buying a home, taking out a car loan, or even just using your credit card, you'll be paying more in interest. It's a vicious cycle. High inflation leads to higher interest rates, which in turn puts more strain on consumers and businesses alike. And here's the kicker: this isn't likely to change anytime soon. The Federal Reserve has indicated that it plans to keep interest rates elevated throughout much of 2024, which means that even as the economy slows, you won't see much relief in your monthly bills. This persistent inflation is a ticking time bomb for many households, particularly those already living paycheck to paycheck. But what does this mean for businesses, especially those in sectors like retail and hospitality that rely heavily on consumer spending? The impact on consumer spending and debt. Let's take a quick trip back to 2008. Remember the housing crisis? Millions of Americans found themselves underwater on their mortgages, trapped in homes worth far less than what they owed. Consumer confidence plummeted, spending dried up, and the ripple effects were felt across the global economy. Now, while the specifics of 2024's economic challenges are different, the underlying threat is eerily similar. A massive squeeze on consumer spending, driven by rising debt and the evaporation of pandemic-era savings. The vanishing pandemic savings. Think back to the early days of the pandemic. Many of us, stuck at home with nowhere to spend money, saw our savings accounts swell. Government stimulus checks, reduced spending on travel and entertainment, and deferred loan payments all contributed to a temporary boost in personal savings. But as 2024 approaches, those savings are all but gone. According to recent studies, the excess savings accumulated during the pandemic have been rapidly depleting, leaving many households with little financial cushion. This depletion of savings is already having a profound impact on consumer behavior. With less money in the bank, people are cutting back on discretionary spending. Those little luxuries like dining out, new gadgets, or vacations. Instead, more of each paycheck is going toward essentials: rent, groceries, gas. And when unexpected expenses arise, there's no rainy day fund to fall back on, leading many to rely on credit cards or personal loans to make ends meet. But this shift from saving to borrowing comes with its own set of problems, which we'll explore in a moment. First, though, ask yourself, have you noticed your own spending habits changing? What are you cutting back on, and how are you managing the rising costs? The debt trap. Borrowing to survive. Now, let's talk about debt. You've probably heard the phrase, living on borrowed time. But what about living on borrowed money? That's exactly what many Americans are doing right now. As savings dwindle, more and more people are turning to credit to fill the gap. Credit card balances are rising, and new loans are being taken out at an alarming rate. But here's the catch. With interest rates at their highest in decades, the cost of borrowing is becoming increasingly burdensome. Imagine this scenario. You're struggling to pay your bills, so you swipe your credit card for groceries, gas, and other essentials. The balance grows, and so do the interest payments. Before you know it, a significant portion of your monthly income is going towards servicing debt rather than meeting your day-to-day needs. It's a vicious cycle that can quickly spiral out of control, leading to financial stress, anxiety, and in some cases, bankruptcy. But it's not just individuals who are feeling the pinch. Small businesses, particularly those in sectors like retail and hospitality, are also struggling to stay afloat as consumer spending drops. These businesses, many of which took on loans during the pandemic to survive, now face higher interest payments on their debt, just as their revenue streams are drying up. This combination of rising debt and falling income is a recipe for disaster, one that could lead to a wave of business closures and job losses in the coming months. And this is where things get particularly concerning. If consumers and businesses are both struggling to manage their debt, what happens to the broader economy? The answer is not pretty, and it's something we'll dive into in the next section. But before we move on, consider this. How much debt are you carrying, and how are rising interest rates affecting your ability to pay it down? Leave your thoughts in the comments. Your experience could be more common than you think. The ripple effect on the economy. As we look ahead to 2024, it's clear that the combination of depleted savings and rising debt will have far-reaching consequences. When consumers cut back on spending, businesses see their sales decline. In response, they might lay off workers, cut hours, or even close up shop entirely. This leads to higher unemployment, which in turn reduces consumer spending even further, a downward spiral that's difficult to escape. But the story doesn't end there. In the next section, we'll explore how these economic pressures could lead to a hidden recession in certain sectors, even if the overall economy continues to grow on paper. We'll also examine how this could affect you directly, whether you're a business owner, an employee, or just someone trying to make ends meet. So stick around, because the worst might still be yet to come. Sectoral stress and the hidden recession. In 2008, the collapse of the housing market sent shockwaves through the global economy. Banks failed, businesses closed, and millions lost their jobs. It was a recession everyone could see and feel. But what if the next economic downturn doesn't announce itself so clearly? What if, instead of a broad, all-encompassing collapse, we experience a series of sector-specific recessions where entire industries struggle in isolation while the broader economy limps along? Welcome to the concept of the hidden recession, a downturn that's just as damaging but much harder to detect. Retail and hospitality, the first to feel the heat. Let's start with two of the most vulnerable sectors, retail and hospitality. These industries were hit hard by the pandemic, and just as they were beginning to recover, they're now facing a new set of challenges. Rising costs due to inflation, higher interest rates, and reduced consumer spending are creating a perfect storm. Think about your local mall or favorite restaurant. How many stores have you seen close in the past year? How many restaurants have cut back their hours or trimmed their menus? These are not just isolated incidents. They are symptoms of a much larger problem. In retail, the shift to online shopping has accelerated, leaving many brick-and-mortar stores struggling to attract customers. Add to this the fact that consumers, squeezed by higher prices and rising debt, are cutting back on non-essential purchases, and you have a recipe for disaster. Many retailers, especially small businesses without the deep pockets of larger chains, may not survive 2024. And in the hospitality sector, the story is much the same. High operating costs and reduced consumer spending mean that many hotels, restaurants, and entertainment venues are operating on razor-thin margins with little room for error. One bad quarter could be enough to push them over the edge. But the real danger here is not just the loss of businesses, it's the jobs that go with them. Retail and hospitality are among the largest employers in the economy, and widespread closures could lead to significant job losses, which in turn would further depress consumer spending. It's a vicious cycle, and one that's likely to play out in slow motion over the next year. Real estate, the bubble that didn't burst yet. Real estate is another sector that's showing signs of significant stress, but in a different way. Unlike in 2008, when the housing market collapsed spectacularly, the current situation is more about a slow deflation. Home prices, after soaring during the pandemic due to low interest rates and high demand, are now leveling off or even declining in some areas. This might sound like a relief for potential home buyers, but it's a double-edged sword. For one, higher interest rates mean that mortgages are more expensive, which reduces the number of people who can afford to buy a home in the first place. For those who do manage to buy, the cost of borrowing eats into their disposable income, leading to less spending elsewhere in the economy. And for existing homeowners, the prospect of falling home values is concerning. If you bought your home at the peak of the market and its value drops, you could end up owing more on your mortgage than your home is worth, a situation eerily reminiscent of the housing crisis. But it's not just residential real estate that's at risk. Commercial real estate is facing its own set of challenges, particularly in the office sector. With remote work becoming the norm for many companies, demand for office space has plummeted. Buildings that were once fully leased are now sitting half-empty, and property owners are scrambling to find new tenants or convert their spaces to other uses. This oversupply of office space could lead to a significant decline in property values, which would have ripple effects throughout the economy. The real estate sector may not be in free fall, but it's definitely on shaky ground. And if the current trends continue, we could see a slow, painful unwinding of the gains made over the past decade. But real estate is just one piece of the puzzle. Manufacturing, caught in the crossfire of global tensions. Now, let's shift our focus to manufacturing, an industry that has always been the backbone of the American economy. In recent years, manufacturing has faced a series of challenges, from supply chain disruptions to the trade wars with China. And while some of these issues have eased, new problems are emerging that could push the sector into a hidden recession of its own. One of the biggest challenges facing manufacturers in 2024 is the rising cost of raw materials, driven by inflation and ongoing geopolitical tensions. Higher costs mean thinner margins, and for many manufacturers, passing these costs on to consumers is not an option in a weak economy. This is particularly true for industries that produce durable goods, such as automobiles and appliances, where demand is already slowing due to high interest rates and reduced consumer spending. At the same time, manufacturers are dealing with a labor market that is both tight and volatile. On one hand, there's a shortage of skilled workers, which is driving up wages and making it more expensive to produce goods. On the other hand, the economic uncertainty means that companies are hesitant to invest in new technology or expand their operations, leading to a stagnation in productivity. It's a tough spot to be in, and it's likely that many manufacturers will struggle to stay competitive in this environment. But perhaps the biggest threat to manufacturing is the risk of a global economic slowdown. If key trading partners like China or Europe slip into recession, demand for American-made goods could plummet, leading to layoffs and factory closures. And given the interconnected nature of global supply chains, disruptions in one part of the world can quickly spread to others, creating a cascade of economic problems. This is the kind of slow-moving disaster that doesn't grab headlines, but can have a devastating impact on the economy over time. Geopolitical and domestic risks. In 1914, the assassination of Archduke Franz Ferdinand set off a chain reaction that plunged the world into war, a stark reminder of how a single geopolitical event can reshape history. Fast forward to today, and while the risks are different, the stakes are just as high. In 2024, the global economy faces a delicate balancing act, teetering on the edge of several geopolitical and domestic risks that could unravel years of economic progress. But unlike the clear-cut beginning of World War I, the threats we face today are more insidious, lurking in the shadows and waiting for the right moment to strike. Geopolitical tensions, the global wild cards. Let's start with the global stage. If you've been following the news, you know that the world is more interconnected and more volatile than ever. From the ongoing war in Ukraine to the simmering tensions in the Middle East, geopolitical conflicts are not just stories on the evening news, they have real and immediate impacts on the global economy. Take, for example, the price of oil. Historically, oil prices have been a barometer for global stability. When conflict breaks out in oil-rich regions, prices spike, driving up the cost of everything from gasoline to food. Now, imagine a scenario where tensions in the Middle East escalate, cutting off a significant portion of the world's oil supply. The ripple effects would be felt worldwide, with energy prices soaring and inflation spiking once again. This would force central banks, including the Federal Reserve, to make difficult decisions about interest rates, decisions that could push fragile economies into recession. And it's not just oil. Geopolitical risks also threaten global supply chains, which are already strained from the pandemic and trade disputes. A single disruption in a key region could lead to shortages of essential goods, further driving up prices and stifling economic growth. But here's where it gets tricky. These risks are unpredictable. Unlike an economic downturn, which can be forecasted based on data and trends, geopolitical events can erupt suddenly, with little warning. It's the classic black swan scenario, an unexpected event that changes everything. And as we move into 2024, the world is facing several potential black swans that could tip the global economy into chaos. But it's not just the international scene we need to worry about. There are significant risks brewing right here at home, and they could be just as disruptive. Domestic challenges, political uncertainty, and economic policy. Turning our attention to the U.S., it's impossible to ignore the political landscape as a source of economic risk. The United States is heading into an election year, and with it comes the potential for significant shifts in economic policy. Think back to the 2016 election. Regardless of which side you were on, there's no denying that the outcome led to a sharp divide in the country's economic direction. Trade policies were overhauled, taxes were cut, and regulations were rolled back, all of which had profound impacts on the economy. Now, imagine a similar scenario in 2024, but in an even more polarized political climate. One of the biggest concerns is the potential for a government shutdown, particularly if Congress remains gridlocked. We've seen this play out before. In 2018-2019, a prolonged shutdown led to delays in government services, financial strain on federal employees, and uncertainty in the markets. A repeat of this in 2024 could be even more damaging, especially if it coincides with other economic stressors like high inflation or a slowing economy. Moreover, the outcome of the election could lead to shifts in fiscal policy that either stimulate the economy or, conversely, create new challenges. For instance, changes in tax policy could impact consumer spending and business investment, while alterations in trade policy could affect global supply chains. But the risks aren't just economic, they're also social. The growing divide between different segments of the population, whether based on income, geography, or political affiliation, could lead to increased social unrest. And as we've seen in recent years, social unrest can have economic consequences, from disruptions in business operations to shifts in consumer behavior. These domestic challenges create a complex environment where the economy could be pulled in multiple directions at once, making it difficult to predict which way things will go. Why this might be worse than a recession. Let's take a moment to think about the Great Depression. It wasn't just the economic numbers that made it a devastating era. It was the pervasive sense of hopelessness, the feeling that recovery might never come. People lost their jobs, their homes, their savings, and for many, the psychological toll was as damaging as the financial one. While today's situation is different, the risks we face in 2024 could create a similar sense of despair, not because of a dramatic economic collapse, but because of a slow, grinding erosion of prosperity that leaves people feeling trapped and powerless. The unseen enemy: economic malaise. Imagine waking up every day to an economy that's technically growing, but not in a way that benefits you. Your job is secure, but your paycheck doesn't go as far as it used to. You're not in danger of losing your home, but you can't afford to move or make any significant upgrades. You're surviving, but barely. This is the reality of economic malaise, a state where the economy is stagnant, inflation remains stubbornly high, and the average person feels like they're falling behind. Unlike a recession, where the pain is sharp but temporary, economic malaise can drag on for years. It's a slow burn that saps consumer confidence, reduces investment, and erodes the middle class. In this environment, even small economic shocks, like a sudden spike in energy prices or a stock market dip, can have outsized effects, exacerbating the feeling that the economy is rigged against ordinary people. This sense of malaise can lead to long-term social and political instability as people lose faith in the institutions that are supposed to protect them. It's the kind of environment where populism thrives, where the promise of simple solutions to complex problems becomes dangerously appealing. But before we dive into the social implications, let's consider how this malaise could manifest in different areas of life. The erosion of personal wealth. Let's start with your personal finances. In a traditional recession, asset prices typically fall, and the economy contracts sharply. It's painful, but it's also usually followed by a period of recovery. In a scenario of economic malaise, however, the story is different. Instead of a dramatic drop, you might see a gradual erosion of your wealth. Inflation eats away at the value of your savings, while stagnant wages make it harder to build up any kind of financial cushion. Consider your retirement savings. If you've been diligently contributing to a 401k or other retirement account, you might think you're on track for a comfortable retirement. But with inflation running higher than expected and investment returns lower than anticipated, you could find yourself falling short of your goals. The same goes for homeownership. If home values stagnate or even decline slightly, while property taxes and maintenance costs rise, your home might no longer be the nest egg you once thought it was. This slow erosion of personal wealth can lead to a phenomenon known as the wealth effect in reverse. When people feel poorer, they spend less, which in turn slows down the economy even further. It's a vicious cycle that can be hard to break, particularly if policymakers are focused on avoiding a recession rather than addressing the deeper issues at play. But personal finances are just one piece of the puzzle. The broader impact on society could be even more damaging. The social and political fallout. Now, let's consider the social implications. When the economy is growing even slowly, there's usually a sense that things are moving in the right direction. People might grumble about rising costs or stagnant wages, but there's a general belief that the future will be better than the present. But in a period of economic malaise, that optimism fades. Instead of looking forward to a brighter future, people start to fear that things will only get worse. This shift in mindset can have profound consequences. For one, it can lead to a rise in social unrest. When people feel that the system is stacked against them, they're more likely to take to the streets, to protest, to demand change. We've already seen hints of this in recent years with movements like Occupy Wall Street and the protests over economic inequality. In 2024, these sentiments could become even more widespread, leading to a more polarized and unstable society. On the political front, this sense of despair can lead to a rise in populism. When people lose faith in traditional institutions, they're more likely to turn to leaders who promise to shake up the status quo, to deliver simple solutions to complex problems. This can lead to a cycle of political instability where each new leader tries to undo the policies of the previous administration, creating uncertainty and making it even harder for the economy to recover. But the biggest risk might be the long-term damage to our social fabric. Economic malaise, unlike a recession, doesn't have a clear endpoint. It can drag on for years, even decades, leaving a legacy of mistrust and division. The longer it lasts, the harder it becomes to rebuild that trust, to bring people together around a shared vision for the future. As we've navigated the complexities of the 2024 economic landscape, it's natural to feel a mix of concern and uncertainty. The risks we've discussed are real, but awareness and preparation are your best defenses. Reflecting on past challenges like the stagflation of the late 1970s, it's clear that staying informed and adaptable is crucial. The insights shared about potential pitfalls, from sectoral recessions to geopolitical risks, highlight the importance of proactive financial planning. Ask yourself, what changes can you make today to protect your financial future? How can you remain agile in the face of uncertainty? Looking ahead, 2024 might be tough, but it also presents opportunities for those who are prepared. Reevaluate your financial plan, stay informed, and focus on building resilience both personally and professionally. While immediate challenges may loom large, don't lose sight of your long-term goals. Remember, information is power, if you act on it. By staying informed and making smart financial decisions, you can not only survive but also find ways to thrive in the years ahead. If you found this video helpful, don't forget to like, share, and subscribe to Economy Explorer for more content that will help you stay ahead of the curve and take control of your financial future.